John Gregg, editor of Farmterio. Welcome to this session, which will look at the complex question of how trade deals, which have repeatedly come at the cost of foreign access to more of Canada's dairy market, could affect that sector in the long term. I'm joined by Al Mussel, who is research lead with Agri-Food Economic Systems in Guelph. Welcome to Canada's Digital Farm Show, Al.
Oh, thanks very much for having me, John.
Tell me, this is kind of a complex question, and it's one that's certainly going to play out over the next few years. Can you tell me a bit, first generally, about how the Canada-U.S.-Mexico trade agreement, the comprehensive CPTPP, and the CETA, the European trade deal, affected dairy farmers in Canada, or will affect them in the future?
Right, sure. Well, let me start with the CETA deal, which is with the EU, because it's sort of the simplest one. In ag and food, it almost boils down to a cheese for beef and pork type arrangement. The EU was given access of 16,000 tons of cheese. It's understood that this is probably going to be fine cheese for the most part. Also, memory serves me correctly, something like 1,500 tons of industrial cheese, or at least in that ballpark. And now, of course, this goes over and above the existing allowance for cheese imports that we have under WTO, 60% of which were already conceded to the EU. So, it's a lot of cheese. And it's cheese that largely we were already getting from the EU. Now, going to CPTPP, it's and sorry, let me back up. On CETA, it's I believe it's a 5-year phase in. We will be entering year 3, and it was a little bit slow getting going initially, but those quotas are being filled. So, some people are going to be seeing European cheeses in stores to a greater extent than they would have, and so that's in play. CPTPP allows for dairy imports into Canada of a much broader range of product. Really, kind of everything from soup to nuts, butter, skim milk powder, cheese, a whole range of yogurt, cream cheese, the whole range of dairy products. Initially, when that was concluded, it included the U.S. Subsequent to that, the U.S. withdrew from the TPP. So there's some things in there, including imports of bulk milk, which were sort of intended for the U.S. because, practically speaking, you're not going to ship bulk milk from New Zealand or Australia to Canada. It's not practical. Some of those may go unfilled, but others, the skim milk powder, I believe there's whole milk powder, if memory serves me correctly, butter, cheese. These will almost surely be filled. Because you've got some major dairy exporting countries that are part of the deal, New Zealand and Australia in particular. CUSMA, what we call CUSMA, the U.S. calls USMCA. They're the same agreement. Really, structurally, is very similar to CPTPP, and that's intentionally so. Without going through line by line, the major structural difference is that the CUSMA agreement allows for significantly more bulk cream imports into Canada, and again, that's just because the U.S. is next door, and that's practical. And the other thing that particularly dairy producers should be thinking about is, look, nobody wants allowance for imports, but if you have to have imports, you're better off to have butterfat dense imports than you are SNF dense imports, because we're structurally surplus SNF. So that's, I think, part of the reason for that. There's also bulk milk access as well as bulk cream. I guess maybe just sort of to tie everything together, this ends up being a lot of access, and on some products, rough math. It's actually very complicated to do this. Rough math. I think we're probably in around 10% access of our market on cheese between the three agreements when they all sort of come into force and are more or less fully implemented. I think I read, I think somewhere Dairy Farmers of Canada, their estimate was 11%. So I mean, we're in the same ballpark, and 10 or 11% of a big number is a big number. And you go down the list. There's some categories that I think we could be 14 or 15% imports. So this is significant.
And solid SNF is solid is not fat.
Right.
That's the everything. Most of the rest of the byproduct of processing milk that's not fat.
Right.
Yeah. So we're partially into the implementation of some of these agreements. What's the effect being in the market so far? Is there something we're seeing yet?
So I mentioned European cheeses, and I think if you talk to processors, this is a concern for them. A significant portion of the import permits, or it's called tariff rate quotas, but really they're import permits, were allocated to retailers and others. Traditionally, in past trade agreements, those permits were granted to importers of record, who tend to be dairy processors themselves, or some traders and maybe a few others. The CETA agreement allocated a significant proportion to retailers. And I think for some processors, this has made their life maybe in some cases quite difficult, because in the past you could look at your own product mix, and some of the products that you could supply very effectively based on domestic milk and your processing capacity and so on, and others you were better set up to import from France or Germany or what have you. Well, now that control has been lost. So and it's gone to the retailer. CPTPP is I think still up and getting going. One challenge there I would anticipate is Australia is in the throes of a significant drought yet again. So I don't know to what extent they will have capacity to participate in it as they otherwise would. For now, I'm sure New Zealand will be involved in this to the absolute extent that they can. And then, of course, CUSMA just came into force July 1st. So middle of August. Now it's a little bit difficult to gauge that at this point. Other than we have some concerns expressed already from the U.S. side on this.
The thought and how someone was sold to dairy farmers is that we now have certainty with the major milk producing company or countries in the world. Can you talk a bit about that? What the Americans have already the questions they're already raising on the CUSMA deal?
Well, I will, but maybe I'll take your first point. So the dairy market in Canada is growing. We have had growth somewhere in the range of 3 to 4%, and from what I've seen in terms of projections that I believe the Canadian Dairy Commission is involved with, that's expected to continue. You worry a little bit in the back of your mind how much food service being offline and for the most part, and a recession would impact on that. But with those questions laid aside for the moment, I think the numbers that have been talked about are probably 3 to 4% aggregate market growth. Well, probably what's going to happen is that through these access concessions that we've made, a significant proportion, I wouldn't say all, but a significant proportion of that growth effectively is going to go to import. So it's muting the growth that the domestic industry has, well, in terms of the part that goes back into quota growth and to producers. Yeah, on the U.S. side, it's, you hate to get started a trade agreement and almost right out of the gate, people are belly aching or complaining about this or that. We weren't too crazy about what the U.S. did on aluminum, and that remains. Apparently, the U.S. has complained bitterly, the industry, some politicians as well, regarding the administration of our tariff rate quotas or import permits. I don't know where they're coming from on that. Well, they seem to be of the opinion that they, from what I can tell, they're not very precise, but it seems as though the Americans thought that they were going to get some of the import permits. So American processors would get some import permits into Canada. Well, we don't do that. In fact, if you go and look at as I have, the Export-Import Permits Act, it says the minister shall allocate import permits to Canadian residents. So if they thought that, then that's incorrect. Maybe there's some sense on the U.S. side that this was going to be handled a little bit like CETA, in the sense that the retailers or some different parties on the importing side were going to be allocated these permits. But again, I don't know why they would think that, because, you know, as I made reference to, the allocation of import permits under CETA has caused some real concern and consternation in the dairy industry, because, as I say, it creates a little bit of a chaotic situation. So after that, I'm not sure we're prepared to do that again. So I don't know why they're surprised by this, but they don't like it much. And you know, maybe I hope I'm wrong about this, but this may be part of a generally more aggressive U.S. negotiating style. You know, as we've seen with, well, any number of cases. So I just mentioned aluminum. You know, they managed to hold over automotive tariffs against the Japanese and got a partial trade agreement with Japan, which they got a bunch of access for ag and food products similar to what we have in CPTPP, but the U.S. didn't have to give up anything to get that. They just simply got that through threats. I hope we don't see a continuation of that.
So back to one of your earlier points about regular growth. So could we, you know, if we have to give up 4 or 5 years of growth to let the imports fill, does that mean eventually we could be back to growth in the sector? Can we grow through the effect of the trade, the cumulative effect of the trade access?
Yeah, potentially. You know, it could be that you go through minimal, you know, in terms of producer quota, you go through minimal growth for some number of years, and then, you know, hopefully that returns. You know, another possibility, and again, just, you know, understand these are sort of probably right in the order of magnitude, but certainly speculative. You know, if there's 3% aggregate growth in the market, you know, the imports get 2% of that, and we're getting 1% in terms of what filters back to our producer segments. It could be something like that.
Then what does the cumulative effect of those trade agreements mean for supply management and the stability of the system? That's another thing that farmers were sold, is that, well, the Americans wanted to get rid of the system. We've actually maintained it. How do you foresee the stability of the supply management system going forward, having given up this much access?
Yeah, you know, I think that the idea that you could get some of these agreements salted away, and that would sort of create peace in our time, or something along those lines. You know, I think there's some good logic to that. It's, you know, supply management's proven to be a pretty robust system, so I think that probably makes some good sense. At the same time, you know, quite apart from trade, although trade has always been a key factor, and doesn't matter when you're talking about milk supply management or chicken or eggs or whatever the poultry segments, there's always been challenges. I think there's going to continue to be challenges. So one of the challenges that I would worry about immediately is, you know, when we have this level of import coming in, as of 2021, we will have no more access for exports that we have to deem as subsidized. And you know, I think, you know, for any of the viewers, I think certainly any of the farmers know that there's no subsidy here that's a check in the mail. It's a deemed regulatory subsidy for our exports. So we're going to have to rankle with that. We should come back in a moment, perhaps, and talk about Class 7, because that's an important issue. There are those issues. Then one of the things that has happened in COVID-19 is, you know, with a lot of the food service industry, certainly through the spring and probably even still right now to a large extent, greatly weakened demand. What that has ended up doing is it really intensifies the market on the retailers. And, you know, processors have raised, dairy processors, along with other products, have raised concerns about market power of retailers. And the retailers, of course, also have, I mentioned that the quota allocations that they have for imports under CETA. All these just act to intensify those market power issues, which I worry that as we roll on through the fall and into next year, it may make it difficult to manage, if there are cost production driven price increases or just more generally the way that producers and processors can work together, because they could face a pretty overwhelming force of market power from the Canadian retailers.
And certainly I've heard that point from from dairy farmers of Canada and some processors that there needs to be, and I think there's been some efforts made to work more together with processors, but there's still that buyer and seller relationship there. And then Class 7, the elimination of Class 7 is certainly an issue. That was the class of milk that Canadian dairy farmers are able to use to lower price excess skim milk powder to sell it on the world market, and that's virtually been eliminated with a small sleeve of exports in the CUSMA deal. What's that effect going to have? They talked about Class 7 as being a nice pressure valve for excesses in the system, but that's not going to be as available.
Yeah, so I think, John, to sort of think this through, we have to step back and remember that the system, milk supply management, balances on butterfat, and just the way the market shakes out, when we balance on butterfat, we are surplus on skim, or what I referred to earlier as SNF. So what that means is we have to find something to do with that product. It comes in essentially fixed proportions out of the cow. So we have to find something to be able to do with that product. What Class 7 allowed us to do was to market that SNF component competitively in either domestic or export uses. One of the effects of that was that after it was initially implemented, it did trigger an increase in skim milk powder exports. And for a period of time, it looked fairly significant. I remember reading something a couple of years ago that the former Secretary of Agriculture, who runs the U.S. Dairy Export Federation, now said that the Canadians were flooding the market with the skim milk powder. Of course, that's ridiculous because the supply can manage systems, so you're not going to flood anything. But the U.S. was concerned about our expansion. So let me see now, 2 dairy years ago, I think we had skim milk powder exports of about 70,000 tons. In the previous year just ended, it was more like 50,000 tons. What we negotiated under CUSMA was that Class 7 would be eliminated and that our exports of skim milk powder and milk protein concentrate combined would be initially no more than 55,000 tons. And then by year 2, 35,000 tons. Now, exports over and above those volumes would be subject to what looks very much like a tax. And in fact, it is going to be taxed. So, how do you try to think through the ramifications of that? Well, the first thing is, in a strange anomaly, year 1 of the CUSMA agreement for products that operate on a dairy year basis, which is an August 1st to July 31st year, because it came into force on July 1st, year 1 was a month for those products. So really, here we are. It's getting into later summer. Really, we're dealing with year 2. So really, the trigger point on powder exports is 35,000 tons. The 55,000 tons was really irrelevant, effectively for that reason. Again, supply managed system. You take last year we had exports of about 50,000 tons. So we're going to have 35,000 ton limit. Assuming that tax makes our product non-saleable above that volume, which the point I want to come back to in a moment, then it means, we're going to export 35,000 tons, and you got roughly 15 to 20,000 tons that needs to find another home. There's probably a number of options that we have for that. One is a class 4M, is a milk class that's used to price skim product into pet food or livestock feed that we used effectively before. And I think it's reasonable to think that there is a market for 15 to 20,000 tons of product there. Now, the problem from a producer perspective is the price is pretty low. So it's not great pricing for that product, but it's it's certainly both economically and optically is far better than dumping, which if you recall 5 or 6 years ago, we were actually getting into that, and that was not pleasant at all. One of the curious things about the way the agreement was written up is these tonnage triggers are combined skim milk powder and milk protein concentrate. Well, skim milk powder is about a 34% protein spec. Milk protein concentrate, the most common formulation of it's a 70% protein. So the price of one is about double the other, but it's the same tax. So there's some discussion and thinking, well, maybe the milk protein concentrate, you might be able to actually export that and be able to pay the tax against it and have that product still be marketable. I don't know whether that's going to happen. And the other thing is, from a practical perspective, we don't have a lot of capacity to make milk protein concentrate here for export purposes. Most of it's used internally in dairy foods companies, essentially to fortify cheese vats. So that all still has to roll out. I should mention there was another element of this that deals with infant formula, but I think that's a fairly targeted thing to accommodate a new plant in Eastern Ontario. So all that to say, we don't have a disaster here with Class 7. It's something that can be accommodated. I think we have some flexibility in how to accommodate it. As a practical matter, so as of today, I think most provinces have probably taken Class 7 off the books already. And by all appearances, it looks like what's happened is Class 4A, which was the traditional butter powder milk price class, has been consolidated, and I think everything's being folded into Class 4A that used to be Class 7.
Thanks for that explanation. I hadn't heard how some of the technical routes that we're taking as Class 7 disappears. So what will these various implications mean for the investment environment around dairy farms over the next while? How do you see the health of the dairy farm economy?
Well, just anecdotally driving around the countryside the last, I'll say 4 or 5 years, or maybe 3 or 4 years, real boom in construction of particularly freestall barns. A lot of old bank barns that maybe would have been renovated 20 years ago. People held off. A lot of those are gone now, and we've got small freestalls, large freestalls, etc. A lot of that was built on the impressive increases in quota that people were getting. I'm going to guess that's probably going to, I think it's slowed down already, quite frankly. And I think that's probably going to continue to slow down and be more, rather than, at one point I heard, that the builders were, 2 years behind or something like that if you wanted to have a freestall barn built. I think that's going to come down much more to sort of individual circumstances rather than industry trends. So it'll probably slow down quite significantly. To me, the bigger threat is really around processing investment. We have had, following the development of Class 7, we did have some investments in processing in Eastern Ontario, a project that Gay Lee had in Western Ontario, Manitoba, BC, Alberta, in essentially retrofitting or changing over dryers to make milk protein concentrate. So that's come through, but really, if you're looking at, we still have quite a range of older plants, and the processors I think may be finding themselves in a bit of a tough position, because basically their export markets as of 2021 are essentially gone, with the exception of what we can do with skim milk powder, milk protein concentrate within the parameters of CUSMA. That's all they've got. And I think if I were a processor, that would concern me because, I may have invested in brands, especially products and so on that are real, higher end, high value products. I can't export any of that. All I can export is skim milk powder and milk protein concentrate, or maybe some blends thereof. But they're going to tend to be commodity type products. I can't attach my brand to it. So that leaves you with growth in the domestic market. But as we've been discussing, the growth in that market is going to be given heavily over to imports. So I'm a little concerned about what the business proposition is for investment on behalf of the processors. And really, at the end of the day, if the processors don't have the interest or the ability to buy increasing volume of milk, well, then you can't have quota growth in your system.
Good. And then, are there any other points you think we haven't hit on this topic that you'd like to mention?
Well, I think we're dealing somewhat specifically with dairy and these three trade agreements. The broader environment in the ag economy, of which dairy is obviously part, is really it's increasingly sobering, quite frankly. We've got the menace of, now we're into the third year of very significant U.S. farm subsidies that they probably hit our grains and oilseed sector first, but they very quickly move into livestock, of which dairy is a component. And what it means is that it insulates the U.S. from adjustment to low prices that these subsidies tend to generate. And of course, since we don't have the treasury to compete with that, it draws us in. And how we deal with that is, in a way, we've been there. This was part of the 1980s, and it was not a good experience for Canada. So that's really worrisome. So it's kind of like we have to find a way to avoid or offset or do something about U.S. subsidies, and I think that goes across commodities. Then we have to worry about China, and China's agenda on the surface seems to be to periodically and we think somewhat arbitrarily block our product. And with China being the second largest economy, it's not like we can avoid it. You really can't effectively. So we have to worry about that. I think the real agenda that China has is not so much that they want to periodically block our product for political purposes, although they do that. I think the real agenda is that they block us, frequently and weaken us enough, they can gain control over some of our agri-food resources. And I think we should be very resistant to that and concerned about it. Whether you're talking about supply managed commodities, more market-oriented commodities, horticulture, et cetera, I think we have to worry about, on one hand, the U.S., the worries we have with the U.S., the worries we have with China, and finding some way to try and steer clear of all of this in an environment where we just don't have the infrastructure to resolve disputes the way that we have in the past. And that's like a sea change for us. Because quite frankly, in non-supply managed commodities, including some supply managed commodities and feathers, we need to be able to export. Otherwise, we can't use the productive capacity of this country.
Well, that's a deeper note to end on. I mean, we need to have another conversation about that at some point. Thanks a lot for taking the time to talk to us on this topic today, Al.
Fair enough. Well, thanks for having me, John.
Okay. Take care.
Very good. You too.